Ladies and gentlemen, Asian guy here. I need you to stop what you're doing right now. Turn off CNBC, close your portfolio app. Because what I'm about to tell you will fundamentally change how you see this market. For months, we've been watching the headlines scream about record stock prices, about the endless rally, about how everything is fine. But behind the scenes, something very different is happening. The smart money isn't celebrating, they're running. I just received data that shows the largest wealth transfer in modern financial history is happening right now, in real time. And it's invisible to 99% of retail investors. High net worth individuals, the people with access to information you and I will never see, are quietly, methodically, systematically reducing their equity exposure at levels we haven't witnessed since 2007. Let that sink in. 2007, the year before everything collapsed. According to internal reports from family offices managing assets over $100 million, equity allocations have dropped from an average of 68% in early 2024 to just 31% as of this month. That's not a rebalancing. That's not portfolio optimization. That's an evacuation. These aren't nervous retail traders panic selling after reading a scary headline. These are the most sophisticated investors on the planet, the people who have survived multiple market cycles, the people who turned $100 million into $500 million during the last crash. And they're telling us something without saying a word. But here's what makes this truly terrifying. They're not selling to raise cash. They're not moving to bonds. They're not hiding in treasury bills waiting for the storm to pass. They're rotating into hard assets at a pace that defies every traditional investment model. Gold allocations among ultra high net worth families have increased 340% in the past 8 months. Real estate purchases, not for income but for wealth preservation, are up 280%. Art, rare metals, farmland, collectibles, anything that exists in the physical world rather than as digits in a computer system. Think about what this means. These families didn't get wealthy by being emotional. They didn't build generational wealth by following trends or buying the dip because some influencer told them to. They have access to the Federal Reserve governors before they speak publicly. They have dinner with the CEOs who run the companies that move markets. They know what's coming before the rest of us even know there's a storm on the horizon. I want to share with you a specific example that illustrates just how dramatic this shift has become. There's a family office in Greenwich, Connecticut, managing $2.3 billion for a tech fortune built during the dot-com boom. In January 2024, their portfolio was 72% equities, 18% bonds, 10% alternatives. Standard allocation for their risk profile. As of last week, they are 22% equities, 8% bonds, 70% hard assets and cash equivalents. A complete inversion of everything conventional wisdom teaches about wealth preservation. When I reached out to their chief investment officer, a man who has been managing institutional money for 3 decades, his response was chilling. He said, "We're not positioning for a recession. We're positioning for a reset. There's a difference." A reset, not a correction, not a bear market. A reset implies that the fundamental structure of the system needs to be rebuilt from the ground up. But the exodus from equities is just the surface layer of this story. The real signal, the one that should make every retail investor pay attention, is where this money is going and why. It's not enough to say they're buying gold. You need to understand they're buying physical gold and taking delivery. They're not buying GLD, the paper ETF that most retail investors use to get gold exposure. They're buying bars, coins, and having them stored in private vaults outside the banking system. Why would sophisticated investors pay the premium, the storage costs, the insurance, the hassle of owning physical metal when they could get the same price exposure through an ETF? Because they don't trust the ETF. They don't trust the custodian. They don't trust the system that issues the paper promises. They want the actual asset in their actual possession because they believe the paper system might not survive what's coming. The same pattern is emerging in real estate, but not the kind of real estate most people think about. They're not buying rental properties for cash flow. They're buying remote land, agricultural properties, assets that produce food and water. One family office recently purchased 847,000 acres in Montana, not for development, for security. They're preparing for a world where the traditional financial system might not function the way it has for the past 80 years. Here's where the story gets even more disturbing. The timeline of this wealth transfer perfectly correlates with insider actions at the highest levels of corporate America. CEO stock sales hit an all-time record in Q3 2024, with executives dumping $63 billion in their own company shares. And these are the people who know their businesses better than any analyst, better than any algorithm. They're selling at prices that, on paper, look incredibly attractive. But it's not just individual CEOs protecting themselves. Entire corporate boards are approving massive share buyback programs while simultaneously liquidating their personal holdings. Think about the psychology of that. Publicly, they're telling shareholders that the stock is so undervalued, that the company should use its cash to buy shares. Privately, they're selling their own shares as fast as SEC regulations allow. They're buying with the company's money and selling with their own money. That's not a contradiction. That's a signal. The acceleration of this trend corresponds almost exactly with the Federal Reserve's policy statements from the Jackson Hole Symposium. While Jerome Powell was speaking publicly about the path forward for monetary policy, the families with direct access to Fed officials were already repositioning their portfolios. They heard what the public didn't hear. They understood implications that won't become obvious to retail investors until it's too late to react. What did they hear? What do they know that we don't? The answer lies in the fundamental mathematics of government debt and monetary policy. The United States currently has $34 trillion in national debt. The annual interest payment on that debt is approaching $2 trillion. That's not sustainable under any economic model that has ever existed in human history. Something has to break. Either the government defaults on the debt, which would destroy the dollar's reserve currency status, or they print the money to pay the interest, which destroys the purchasing power of the dollar. The high net worth families have run this calculation. They've stress tested their portfolios against both scenarios. In either case, holding paper assets denominated in dollars becomes a path to wealth destruction. Real assets, physical assets, things that exist independent of government promises and monetary policy, become the only rational hedge. But there's another layer to this story that makes it even more urgent. The institutional infrastructure that supports equity markets is showing signs of stress that parallel 2008, but in a different sector. Prime brokerage, the system that allows large investors to borrow money to buy stocks, is experiencing liquidity constraints that weren't present even during the banking crisis of March 2023. Family offices are reporting difficulty accessing the credit lines they've used for decades to optimize their portfolio leverage, not because their credit profiles have deteriorated, but because the banks providing those credit lines are conserving capital for what they see coming. When JP Morgan, Goldman Sachs, and Morgan Stanley simultaneously tighten lending standards for their wealthiest clients, it's not about individual risk assessment, it's about systemic risk management. The timing of this credit contraction coincides perfectly with the equity exodus we've been discussing. As borrowing costs increase and credit availability decreases, leveraged equity positions become untenable. But rather than simply deleveraging and staying in stocks, the smart money is using this forced deleveraging as an opportunity to rotate entirely out of financial assets and into real assets. This creates a feedback loop that accelerates the wealth transfer. As high net worth investors sell equities to reduce leverage, stock prices face downward pressure. As stock prices decline, margin requirements increase for retail investors who are still holding leveraged positions. As retail investors are forced to sell, prices decline further. The institutional investors who exited early are then able to use their cash to acquire real assets at increasingly attractive prices, while retail investors are trapped in a declining paper asset system. The most disturbing aspect of this entire process is how invisible it is to the average investor. The financial media continues to focus on daily price movements, quarterly earnings reports, and Federal Reserve statements. They're not reporting on family office allocation changes because that data isn't public. They're not discussing the institutional credit crunch because it doesn't affect retail brokerage accounts. They're not analyzing the correlation between insider selling and smart money asset rotation because it requires connecting dots across multiple data sources that most journalists don't have access to. By the time this wealth transfer becomes visible in mainstream financial reporting, it will be complete. The families who understood the signal will have successfully moved their wealth out of the paper system and into real assets. The retail investors who relied on CNBC and financial advisors for guidance will be holding the bag in a declining equity market with limited options for recovery. The mathematics of this situation are brutal but simple. There are approximately 750,000 households in the United States, with net worth exceeding $5 million. If each of these households reduces their equity allocation by an average of $2 million, that represents $1.5 trillion in selling pressure that has nothing to do with economic fundamentals or corporate earnings. It's pure portfolio reallocation based on information and analysis that retail investors don't have access to. That $1.5 trillion doesn't disappear. It flows into alternative assets, creating price appreciation in gold, real estate, commodities, and other hard assets. As these assets appreciate, they become more expensive for retail investors to acquire. The wealth gap doesn't just widen, it becomes structural. The families who moved early own appreciating real assets. The families who moved late own depreciating financial assets. This isn't a prediction. It's not a theory. It's happening right now, today, while retail investors are celebrating new highs in their 401k statements. The great wealth transfer is the sound of smart money exiting the system before the system realizes it's broken. The question isn't whether this trend will continue. The question is whether you can hear the signal before it's too late to act. We are witnessing the end of the paper asset era and the beginning of the real asset era. The families who understand this transition will preserve and grow their wealth. The families who don't will watch their paper wealth evaporate, as the monetary system that created it undergoes the reset that the smart money is already positioning for. The transfer is happening. The only question is which side of it you want to be on. Here's what makes this even more sinister. The Federal Reserve's own data shows that household equity holdings as a percentage of total assets have reached levels not seen since 1999. We all know what happened in 2000, but this time is different. This time, the smart money isn't waiting for the crash to reposition. They're repositioning now, while asset prices are still elevated, while they can still get full value for their paper holdings. The velocity of this reallocation is accelerating. What started as a gradual shift in family office portfolios 6 months ago has become an urgent exodus in the past 6 weeks. Private wealth advisors are reporting that client meetings that used to focus on optimization and tax strategy are now dominated by a single question. How quickly can we convert paper assets to real assets without moving the market against ourselves? The answer reveals another layer of this crisis. Large portfolio liquidations can't happen instantly without destroying the value of the assets being sold. So these families are using sophisticated strategies, dark pools, and algorithmic trading to gradually exit their positions without creating obvious selling pressure. They're selling into strength, using every rally as an opportunity to reduce exposure while maintaining the appearance of a healthy, rising market. This creates an illusion that confuses retail investors. Stock prices continue to reach new highs, but the underlying ownership is shifting from strong hands to weak hands. The institutions and families that could weather a major correction are selling to pension funds, 401k plans, and retail investors who cannot weather a correction. It's a transfer of risk from those who can afford to lose to those who cannot. The pension fund purchases are particularly troubling because they represent retirement security for millions of Americans who have no idea their future is being used as exit liquidity for billionaire families. State pension systems, corporate 401k plans, and union retirement funds are the buyers of last resort as sophisticated investors exit the market. When the correction comes, it won't just destroy individual portfolios. It will threaten the retirement security of an entire generation. Perhaps the most telling signal is what's happening in the private markets. Private equity funds, which traditionally compete aggressively for deals, are suddenly flush with undeployed capital. Not because deal flow has decreased, but because their limited partners, the high net worth families and institutions that fund these deals, are refusing to commit new capital to anything that can't be easily converted back to cash or hard assets. Private equity partners describe a complete shift in investor psychology. Families that have been aggressive growth investors for decades are suddenly asking about capital preservation rather than capital appreciation. They want to know about downside protection, liquidity provisions, and asset backing. They're thinking like people preparing for a siege rather than an expansion. Hedge funds face redemptions. Families learn paper loses value. What they understand, retail investors haven't. Transfer happening because money knows